it sitting now? Or it doesn't show you where? Okay, ma'am, be ready.
Good day. My name is Mrs. Wimbai Chingwe, a teacher at the Dow Academy. I'm going to remove my mask so that you can hear me properly. I am teaching accounting, commerce, and business studies. Before we start our lesson, remember to follow COVID protocols. Remember to wash your hands, sanitize, maintain social distance, mask up, always put on your mask and avoid visiting. We will be live from every Tuesday to Friday. Remember to tune every Tuesday to Friday. Okay, we are going to be looking at the income statement. That is what we are going to be looking at today. And this applies to commerce. The subject code is 7100. It is O level. And the income statement also, it applies to accounting code 0452 IGCSE. The reason why we are looking at the income statement is most businesses, their aim is to make profit. The aim of most businesses is to make profit. And how do we check if the business is making a profit? We check through the income statement. Of course, not all businesses have the aim of making profit. Some businesses, they have other aims. Some businesses, they aim to expand. Some they aim to grow. Some they aim to add value. Some they aim to survive. Some businesses, they are just service providers. Some they aim to increase the market share. Okay, we are going to be looking at the slides. What is an income statement? An income statement, it is meant to calculate profit. But before we look at that, an income statement is divided into two sections. An income statement is divided into two sections. We have got the section which is known as the trading section. The trading section, it is meant to calculate gross profit. We are going to look at more on that in the next slide. And we have got a section which is known as the profit and loss section. So let's look at the trading section. What is the purpose of the trading section? The trading section, it is meant to calculate gross profit. How do we calculate gross profit? Gross profit is simply the difference between the selling price and the cost of goods sold. That is the simple. And what is the formula? Gross profit is calculated by sales revenue minus cost of goods sold, or less cost of goods sold. That is the simple formula. But you realize that in a normal business, gross profit is not calculated like that. We are going to look further, but before we look further, let's define sales revenue. What is it? What is sales revenue? It is the amount of money that we receive from selling goods and services. Remember, some businesses, they sell goods, and some businesses, they are service providers. And how is sales revenue calculated? It is calculated by price multiplied by the quantity of goods sold. And when you are showing sales revenue in the income statement, remember, some customers, they may bring back goods. If a customer is not satisfied with goods, or say the goods are damaged, the customer can bring back the goods. So that one, we call it sales returns. When the customer bring back the goods, it is called sales returns. So the sales revenue figure should always represent the total number of goods that you have sold less the sales returns, the goods that have been brought back by the customers. Also, we said in a normal course of a business, cost of goods sold, they are not as simple as maybe you just buy goods and then you sell the goods. When you buy goods, some of the goods, they may be bought that year. Some of the goods may be inventory from the previous year, what we'll call opening inventory in the current year. Some goods may be in stock at the beginning of the year, what we call opening inventory. And some of the goods may be purchased during that financial year, and we call that purchases. Some of the goods, by the end of the year, they may remain unsold, and we call that closing inventory. And the formula for calculating cost of goods sold is opening inventory, we add purchases, and we subtract closing inventory. Remember also that just like sales, purchases may also be affected. We are going to look at how we calculate the net purchases. Purchases may be affected by the cost of transporting goods into the business. Purchases may be affected by returns when we buy goods from our suppliers. If we are not satisfied with the goods, or if the goods are damaged, we may take the goods back to the supplier, and we call that purchases returns. So what is it that affect purchases? Purchases can be affected by the cost of transporting goods. If the cost of transporting goods has been paid, and we call that carriage inwards. And we are saying this figure must be added to the cost as it increases the cost of purchasing goods. Sometimes, especially if you look at small businesses, you realize that some people, they take goods for their own use, what we call drawings. When a person takes goods for their own use, we call that drawings. So that figure should be subtracted from the purchases. So what is the formula for calculating purchases? Net purchases, we say purchases less purchases returns plus carriage inwards less goods taken for own use, and then we'll get our net purchases. So that is the trading section, which we use to calculate the gross profit. Remember, we said gross profit, it is sales revenue minus cost of goods sold, and then we get the gross profit. So the next section that we are going to be looking at is calculation of the profit and loss section, the calculation of net profit. It is calculated in the profit and loss section. So we calculate net profit or loss. It doesn't always mean that when the business is when a business is running, it is always making a profit. Sometimes businesses, they do make a loss. So we are going to be looking at the profit and loss section. We said the profit and loss section, it calculates the net profit. The other name for the net profit is profit for the year. So what is net profit? Net profit is the final profit after other income has been added to the gross profit and the running expenses have been subtracted. Some businesses, they do not only get their income from selling goods. Some businesses, besides selling goods, maybe they've got a business, a house, maybe they are renting out, they receive rent. So rent received is another income. So it should also be added to the gross profit to get the total income. Some businesses, they get other income, for example, commission received. If they are working on behalf of another organization, they get commission received. This is another income which should be added to the gross profit. And then we get total income. After that, we now subtract the running expenses. And remember, what are expenses? Expenses, they simply mean the cost of running the business, what you incur when you are running the business. For example, when you're running the business, you pay wages and salaries to your employees. You pay for insurance. If you've got motor vehicles, you pay for motor expenses. If you are not, if the building that you are using is not yours, you pay for rents and rates. And what is the formula for calculating the profit for the year, the net profit? It is calculated by gross profit. We add other income and we subtract the expenses. So in our next slide, I am going to show you a small example on how net profit is calculated. So I prepared a small example there. The question is saying, draw an income statement for the year ended 31 December 2020. Remember, we talked about opening inventory. How do you tell that this one is an opening inventory, especially for those who are doing commerce 7100? Opening inventory, you can tell by the date that it is the opening inventory. Like there it is saying 1 January 2020, our opening inventory. So you can tell that that is our opening inventory. And how do you tell that this is the closing inventory? If you go at the bottom, you will tell that this is the closing inventory by the date 31 December 2020. So that is how you tell the difference between opening inventory and closing inventory. What are carriage inwards? If you remember, carriage inwards, this is the cost of transporting goods into the business, and we should add it to purchases. What are returns inwards? Returns inwards, it simply means goods returned by our customers, the sales returns. And we said we subtract that from our sales so that we get the net sales. What are returns inwards? Returns inwards, they are also known as purchases returns. We subtract that from our purchases so that we get net purchases. The sales, the figure that we get from selling our goods and services, the amount of money that we get from selling our goods and services. Then purchases, what are purchases? These are goods bought for resale. We use them when we are calculating the cost of goods sold. Insurance, the cost of running a business. Wages is also a cost of running a business. Those are expenses then. So that is an example, and I worked out the example. The example is worked out at the, I'll show you the worked example. Okay. That is how an income statement is supposed to look like. We have got 3 columns there. The outer column, we can call it, it's more of the credit side, and the inner column, it's more of the debit side, and then the other column, it is more of a miscellaneous column, the column that we use to calculate, to do our calculations. So an income statement, this is a simple income statement, especially for the students who do commerce. For those who do accounting, this is just too simple. So how do you do the income statement as it is presented there? First, you calculate your net sales, and then you calculate the cost of goods sold. The net sales you calculate by sales revenue less returns inwards. Then you get your net sales of 48,000, and then less cost of goods sold. That is a heading. It is showing how the cost of goods sold are calculated. We calculated by opening inventory, adding purchases, then less closing inventory. But if you look at the question there, the question that I showed you before, if you look at the question, it shows that there were other factors affecting the purchases. So we need to calculate the net purchases. So how do we calculate the net purchases? It is purchases less returns outwards. The purchases returns, goods that we returned to our suppliers, and we add carriage inwards, the cost of transporting goods into the business. And then we get our net purchases. We add the net purchases to the opening inventory. We get the goods available for sale. Then we subtract now our closing inventory. The 36,200 that we get there, it will be our closing, it will be our cost of goods sold, sorry. And then now net sales less the cost of goods sold, the net sales of 48,000 less the cost of goods sold of 36,200, we get a gross profit of 11,800. And then now we subtract expenses, insurance of 1,000, wages and salaries of 3,000. Our total expenses are 4,000. We get the net profit of 7,800. So this is simplified. But if you look at those, remember I said when I started, I said I am going to cover both accounting code 0452 and commerce code 7100. So those who do commerce, I think you go up to there. You go up to where I have covered so far. So now I am going further to assist those who do accounting. When you're doing accounting, there are other adjustments that you make when you are making the income statement. We are going to go back to our slides so that you look at the other adjustments that we go back, that we look at when we are looking at our income statement. Basically, they are 3, or we can even say there are 4. The adjustments are accruals and prepayments, and then we have got depreciation, and then we have got what is known as irrecoverable debts and provision for doubtful debts. And we also look at goods taken for own use by the owner. But that one we have already looked at it when we are looking at the trading section. These 3 accruals and prepayments, depreciation, irrecoverable debts, and provision for doubtful debts, we look at them when we are looking at the expenses. When we are looking at the expenses, they affect our expenses. So I am going to start with accruals and prepayments. I'll remind you how we tackle accruals and prepayments. What is an accrual? We need to understand what an accrual is. An accrual is an amount due in an accounting period which remains unpaid at the end of the accounting period. Like if you look at the example that I gave you before, we said our accounting period is running from 1 January to 31 December 2020. That is our accounting period. So if there is an expense that we do not pay by 31 December 2021, that will be our accrual. A good example of an expense that usually remain unsold at the end of the financial year is water, for example. Most of us, we do not pay for water at the end of the financial period. So, but when you are preparing an income statement, that expense which remain unsold at the end of the financial period, it should be added back. So we are saying when you are preparing an income statement, the accrued amount is therefore added back because we have benefited from the service, we have received the service during the accounting period, but we have not paid for the service. So we should add it back. So please remember that you add that expense to the particular expense. For example, if it is water, you add it to the water that you already have in your trial balance. If it is heating and lighting, you add it to that particular expense. Still under accruals and prepayments, we have got what is known as a prepayment. What is a prepayment? We are saying a prepayment is an amount that is paid in advance. A good example is electricity. Most of us, we have got prepaid meters. We pay for our electricity in advance. So if by 31 December, maybe you still have a credit in your meter, you still have, say, 100 puller in your meter, it means that is an advance. So because it is not for that particular period, that expense should therefore be subtracted. So it means that payment has been made during the financial year for some benefit in future. So we should subtract that payment. It should therefore be subtracted. Then the next adjustment that we should remember when we are preparing our income statement, we should remember depreciation. Depreciation is an estimated loss in value of non-current assets over its expected working life. An asset loses value. When we use it, it loses value. So remember that there are three methods of calculating depreciation. We have got what is known as the straight line method of calculating depreciation. And this method, it is calculated on cost. When we are talking about the cost, we simply refer to the amount that you bought the asset for. And then we have got the reducing balance method, which is calculated on net book value. What do we mean by net book value? Net book value, you simply subtract the accumulated depreciation from the cost. That is your net book value. So the reducing balance method, it is always calculated on net book value. And then the last method is the revaluation method. What you do with the revaluation method, you simply compare the current value of the asset with the previous value of the asset. For example, I'll give you an example of my phone. I bought my phone for 1,200 in 2019. I still have the same phone, but I don't think that phone is still worth 1,200. It is now maybe say worth 800. So it means the phone has lost value of 400. So the 400 is the depreciation. That is the revaluation method. Then lastly, we are going to look at irrecoverable debts and provision for doubtful debts. Most businesses, they sell their assets on credit. And when businesses sell their assets on credit, there is a risk that debtors may not pay. So what is an irrecoverable debt? An irrecoverable debt is a debt owing to the business which will not be paid by the debtor. Some debtors, they may not pay because they have gone out of business, for example, they are not able to pay. Or some debtors, after buying from you on credit, after buying from the business on credit, they may just disappear. And therefore, when it happens like that, an irrecoverable debt, it is an expense to the business. So it should be subtracted from the gross profit. Then we are going to look at provision for doubtful debts. Provision for doubtful debts, it is an estimate of the amount which a business will lose in a financial year because of irrecoverable debts. What the business is simply doing here, they are estimating what will happen if debtors, they do not pay. So what will be happening is we'll be applying the prudence concept. The prudence concept, it states that assets should not be overvalued. So when you are applying the principle of provision for doubtful debts, what we are simply doing is we do not want to overvalue our asset debtors. So we apply the principle of provision for doubtful debts. We make a provision for doubtful debts. And also the provision for doubtful debts, when you compare the previous financial year's provision for doubtful debts to this year's provision for doubtful debts, if you compare, if there has been an increase in the provision for doubtful debts, for example, it means it is an expense. But if the provision for doubtful debts has decreased from last year's provision for doubtful debts, it means it will be treated as an income. Okay, thank you. Remember to ask your questions. We may go for break.
The music just feels so good. You're on the number one.
They're not per Queen Stuff on Tuesday. And those were our sports update. Thank you very much.
All right. Do you know what FIFA stands for?
I don't. I'm so disappointed.
Even the bell is disappointed.
Okay.
Welcome to your future.
You can't live without. This is your radio.
Only the best internet radio station in the world.
Hi everybody, my name is Tiago Nteta from the Dow Academy, and I would like to welcome you all to the TDA Sport Challenge, where you stand a chance to win great prizes just by keeping fit. All you need to do is post videos of your daily challenge progress on our social media pages. You can even send some of your videos to our WhatsApp number. The challenges that we have for you are the push-up challenge and onto the push-up challenge, where you'll be required to increase the number of push-ups that you do on a daily basis. On day 1, we start with 5 and we increase by 5 every day. So day 1 is 5, day 2 10, day 3 15, and so on and so forth. The Around the World Challenge and the Keep Yappy Challenge. We are at the Dow Academy secondary campus. For this challenge, you'll need a ball, and the whole aim of the challenge is to juggle the ball in the air without it touching the ground, using any part of your body except for your hands. It should look something like this. Today you did 10, tomorrow try and beat it. Try and do 15, try and do 20, try and do as much as you can for the end of the challenge. Now our prizes include a one-term free admission to the Dow Academy Tech Series, 50 Pula airtime, as well as TDA merchandise. So come on everybody, let's get outside, let's get fit, and good luck to all those participating.
I am an in-school participant at Stepping Stone.
Great.
I was doing a scholarship program,
Okay.
and yeah, I'm actually doing my Form 3
Where?
at Ituteng CJSS.
Wow, you should have come to the TDA. The Dow Academy is go radio, it's go building computer, and it's go mechanics program. We do coding, man. We do like the Walt Disney stuff, like with draw, animate,
Yeah.
graphic novels. You know about that?
Yeah, it's kind of like the Harvard of Muchu.
It's the Harvard of Machuda, God. I'm telling you, oh, man.
Welcome to your future.
You can't live without. This
You're
is your
listening to
radio.
only the best internet radio station in the world.
Good afternoon. I am Katlego Modise. I just wanted to ask this question. Am I expected to prepare the whole income statement? Thank you so much.
Correctly. In commerce, you are not expected to prepare the whole income statement. Usually in commerce, there'll be some missing figures, and then you are expected just to fill in the missing figures. But you can't fill in the missing figures if you do not know how to prepare the income statement. So it is advisable that you know how to prepare your income statement so that you'll be able to fill in the missing figures.
Another question from WhatsApp. Let's hear it.
Tabambohosi, what is the difference between depreciation and appreciation?
Let's play that again.
Tabambohosi, what is the difference between depreciation and appreciation?
Okay. What is the difference between depreciation and appreciation? Depreciation, we said it is the loss in value of a non-current asset over a period of time. And then appreciation, it is the increase in value of a non-current asset over a period of time. A good example of assets that appreciate are land and buildings.
Going on with the questions, Bohosi from Boka, Boka from Boka. Why do businesses prepare income statements?
Why do businesses prepare income statements? Businesses, they prepare income statements to check if the business is making a profit or a loss. That is why they prepare income statements. Remember, most private businesses, they are started with the aim of making a profit. Therefore, they need to check if the business is making a profit or a loss.
Another question from Karo in Kaburoni. Explain further on the calculation of reducing balance method of depreciation. Explain further on the calculation of the reducing balance method of depreciation.
Okay. The reducing balance of depreciation, it is one of the methods. We said there are three methods, and the reducing balance method is one of the method of calculating depreciation. The reducing balance method, it is calculated on net book value. The percentage is calculated on net book value. How do we get the net book value? The net book value is calculated by subtracting the total depreciation from the cost of the asset. So usually we say cost minus the total provision for depreciation, then we get the net book value, and then that net book value we will calculate with the percentage given, we calculate the reducing balance method.
I hope that you got that. Another one from the table. He says there are businesses whose aim is not to make profit. Are they expected to prepare the income statement?
Yes, of course, we have got different. The question was businesses whose aim is not to make a profit. Are they expected to prepare an income statement? Yes, of course, we've got different types of businesses. We've got non-profit making organizations. Non-profit making organizations, for example, orphanages. Yes, they are not expected to prepare an income statement, but they prepare what is known as an income and expenditure, which is similar to an income statement. The income and expenditure is simple. They simply list their income, their total income. They get their total income, and then they subtract the total income. They subtract the expenses, their expenditure, from the total income. So theirs is not known as an income statement, but it is known as an income and expenditure.
Thank you for answering the question, ma'am. We have another question. He said, hello, TDA, Teleradio. Thank you for the Ask Your Teacher program. He says, how can I best prepare for my commerce and accounts paper coming up on October and November?
I'll start with accounting. Accounting is a practical subject. For you to prepare for accounts, practice. You need to practice every day. You can start especially with the topics that you are not comfortable with. You practice them. Make sure you practice every day. And then with commerce, make sure that you know your content. It's a content subject and it is bulky. You need to read and make sure that you know all the aids to trade, warehousing, advertising, banking, transport, insurance, communication. You know that. And you also know the introduction to commerce, your production, your international trade, and then I think you'll be home and dry.
Thank you, our live audience.
Okay, thank you so much for your questions. We are going for a short break.
Well, last year when I was in standard 6, the school introduced a club called the Media Club. I decided to join it, then I got accepted. And that's how we came to make the future of this land. Like my grand queen mother would say,
be fearless. Be like your father.
Well, in the film, I learned a lot about acting and types of shots that the camera takes. And my favorite character in the movie is Mati, the place where my father was born. A place his forefathers lived and passed on to the afterlife. Now it's just a place. I was surprised to see myself in the newspaper.
This is the first time. How did your parents feel about that?
My parents felt proud and happy for me. I got the role because of my martial arts. I knew karate, went to karate school, and I tried to fit in so that I can do more exercises and be able to get that. In Botswana here, I know that we have a low population. So what I want is that the children to be inspired and it should go to other countries to show that the children, no matter how young they are, they can do well in their lives.
People worth saving.
They're not the kind of people worth saving.
Like Amazon, we watch India's TV, we always see Studio Universal movies. I want our movies to also be shown on Studio Universal and be proud of ourselves as Botswana.
A hunt to kill.
Okay, welcome back. Always remember to follow your COVID protocols. Remember to wash your hands, to mask up. Also remember to sanitize, and you should remember that you are not supposed to move unnecessarily. So we are going to have a recap of the lesson. What is it that we covered today? We were looking at the income statement. So you should be able to calculate your cost of goods sold. I hope you remember how we calculate cost of goods sold. It is calculated by the simple formula, opening inventory. We add our purchases and then we subtract our closing inventory. Remember, there are things that affect the purchases. What affects our purchases? Our purchases are affected by goods taken for own use by the owner of the business. Purchases are also affected by carriage inwards, the cost of transporting goods into the business, and they are also affected by returning goods to the supplier. Also, how do we calculate gross profit? I hope you still remember that. Gross profit, it is simply calculated by sales less the cost of goods sold then we get our gross profit. And then lastly, how do we calculate our net profit? Net profit, it is calculated by the formula gross profit less expenses. Expenses, which we said are the cost of running the business. Then we said there are other adjustments that affect expenses. And when you are in an examination, I urge you to start with the additional information which has got other adjustments, because that is where most of the marks are. So you should know how to tackle the accruals and prepayments. We said accruals, we add the accrued amount to the expense. And then how do we treat prepayments? Prepayments, we subtract. When an expense has been prepaid, that amount that we prepaid, we subtract. Then the other adjustment that we have is provision for depreciation. Always remember to calculate your depreciation and be sure of the method of depreciation that the examiner has asked you. There are three ways in which depreciation can be calculated. We have got the straight line method, which is calculated on cost. We have got the reducing balance method, which is calculated on net book value, and the revaluation method. And then the last adjustment is irrecoverable debts and provision for doubtful debts. Remember, irrecoverable debts are an expense to the business, a debtor who has failed to pay. We're expecting an income from that debtor, and then the debtor fails to pay. That is an expense to the business. And then we make a provision for irrecoverable debts, a provision for doubtful debts. Some debtors, we may fail to pay, so we make a provision for them because we do not want to overvalue our asset debtor. And lastly, if there are goods taken for own use by the owner of the business, we should also make adjustments for them. We should subtract them from the purchases. Thank you.
The best songs on the radio. This is my only favorite station.
You're listening to only the best internet radio station in the world.
Well, thank you so much for watching the show. Remember to always follow the COVID protocols. Remember to wash your hands, sanitize, wear your mask up. Thank you so much.
You're listening to only the best internet radio station in the world.